Welcome back, everyone, to the deep dive.
Yeah.
Today we're going to dive into some stuff that honestly is pretty fascinating and kind of potentially scary at the same time.
Oh, yeah.
Yeah. When you think about it, like so much of the economic theory, assumes that everybody's totally rational when it comes to money.
Right.
But then you look back at history
Yeah.
and it's like, oh my gosh, like how often that goes completely out the window.
Totally.
You know what I mean? Like the canal craze,
Right.
the railroad boom, all
Yeah.
these times when it's like things just totally detached from,
Yeah.
you know,
Reality.
reality. Yeah.
Yeah.
Charles Kindleberger, had that great term for it, like manias.
Oh, yeah. Manias. Yeah.
And it's just like, it's so funny to me, like how people even describe them like way back when, like these terms like, insane land speculation,
Uh-huh.
financial orgies,
Well,
frenzies.
that's great.
Yeah. It's just like really makes you wonder if we ever actually learn.
You would think we would. Right. But it seems like every generation kind of has to rediscover these things and kind of go through its own little cycle of these manias.
Its own little bubble and bust.
Yeah. Right.
And that's kind of what we're going to be diving into today. Like,
Yeah.
are we in one of those moments right now?
Uh-huh.
Because the sources we've got definitely suggest that something kind of weird and potentially bubbly is going on.
Interesting.
Yeah. So, like, right off the bat, there's this thing, I don't know if you've ever heard of this. It's called the BOFA Global Fund Manager Survey.
No, I haven't.
Okay. So it's basically like they survey all these, big fund managers,
Uh-huh.
like the really professional investors.
Got it.
And one of the things they track is their average cash levels. So, like, how much cash are these guys actually holding,
Yeah. Okay.
on the sidelines?
Uh-huh.
And right now, it's near record lows.
Wow.
So basically what that's telling you is these guys are feeling super confident. They're like, let's put all our money to work.
They want to be in the game, right?
Yeah.
Yeah.
Want to be fully invested.
Uh-huh.
And then there's this other thing. This one I find super fascinating.
Okay.
It's called the euphoriameter.
The euphoriameter.
Yeah.
Interesting.
So this is from top-down charts.
Okay.
And basically what it does is it looks at, how people are feeling about the market sentiment.
Mm-hmm.
It looks at how expensive stocks are relative to their earnings. So, the forward PE ratio.
Yeah.
And then it also factors in the VIX.
So the VIX is, remind me again.
Volatility index.
Oh, volatility. Right.
Yeah. So basically a measure of like how much fear there is in the market.
Right. So a low VIX means that people are feeling pretty complacent,
Exactly. Yeah. So like nobody's really worried.
right? Uh-huh.
And guess what? This euphoriameter hit a record high even before the U.S. election back in October 2024.
Wow.
So it's like all this optimism like already baked in.
Yeah.
Even before we know like...
Who's going to win or anything.
Exactly. Yeah. And I mean, that's pretty striking, right?
Yeah. I mean, it seems like there's a lot of, well, I don't know if I want to call it irrational, but like there's certainly a lot of exuberance out there.
Uh-huh.
So that in itself, I think, is a really big takeaway.
Right.
Regardless of kind of what the fundamentals are saying, there's clearly the sentiment out there that things are great.
Yeah. And that's where it starts to get a little bit, worrying. Because when we look at some of the other sources we've got, the economic picture isn't necessarily all rosy.
Yeah.
Like there's some stuff in here that actually points to a potential real-term recession.
Oh, wow.
Yeah. And definitely some struggles, for a lot of people out there when it comes to wages and even just finding jobs.
I mean, that makes sense, right? We've all seen. I mean, you go to the grocery store, you see what's happening with prices. It's everybody's feeling that squeeze.
Yeah. And this is where some of the data gets really interesting because we've got figures 3 and 4 in our materials here. And they show this trend of what some people are calling like the great replacement of American workers.
Oh, interesting.
Yeah. So under the Biden-Harris administration, the data suggests that native-born workers were actually losing jobs.
Wow.
While foreign-born workers were gaining jobs up until October 2024.
Okay.
And I just want to be clear here, like, we're just reporting what the data says.
Sure.
We're not trying to take sides or anything.
Yeah, of course.
It's just that's what the data shows. And on top of that, the October payroll numbers were actually revised downwards.
Oh, really?
Yeah. So that means the job market was actually weaker than they initially thought.
Interesting.
Yeah. So it's kind of like, on one hand, you've got all this optimism in the markets.
Right.
But then the reality on the ground for a lot of people is maybe not so great.
Yeah, it's a bit of a head scratcher for sure.
A little bit of a disconnect there for sure.
Yeah.
And then if you factor in what's been happening with real wages.
Right, because it's one thing to have a job, but it's another thing to actually be able to make ends meet, right?
Exactly, yeah. Like, what are people actually earning after you factor in inflation?
Right.
And that's where it gets kind of scary because they've been going down.
Oh, wow.
Yeah, so people's purchasing power is actually decreasing.
And I think, and this is something I think that doesn't get talked about enough, it's like even if you're using the official government statistics for inflation, you know, which a lot of people would argue are understating the real problem.
Right.
Like even with those, real wages are falling.
Right.
So if you use like more realistic measures of how much the cost of living has actually gone up, it could be even worse.
Yeah, I mean, think about like, you know, groceries, gas, housing.
Everything, right.
Yeah. And this is where Figure 5 from the National Association of Realtors is like just a huge punch in the gut.
Okay.
Because it shows the percentage of U.S. households and renters who can actually afford to buy a median-priced home. And it's way down compared to 2019.
Wow.
So it's like a huge chunk of the population is getting squeezed.
Yeah.
And it makes you wonder, you know, with all this going on, what is fueling this like crazy enthusiasm in the stock market?
Right, exactly. Like what are people seeing that maybe we're not?
Yeah, and I think this is where like Bertrand Russell's quote comes in.
Okay.
You know, he said, "The whole problem with the world is that fools and fanatics are always so certain of themselves, and wiser people so full of doubts."
Yeah. It's that certainty that's scary, right?
Right.
Because if you're too certain, you're probably not thinking critically enough about all the things that could go wrong.
Exactly. Yeah. Yeah. And it seems like there's a lot of that certainty driving people to buy U.S. stocks right now. Even though we've got these signals of a potentially weakening economy,
right?
You know, investors are holding almost no cash. That euphoriameter is super high.
Right.
And then on top of all of that, stock valuations are near record highs.
Oh, wow.
Yeah. So like Figure 6 shows the price to sales ratio for the S&P 500.
Okay.
And it's just way up there. So that's another thing that should be making people think twice.
Yeah, it's definitely worth paying attention to. And I think, you know, one of the things that kind of jumps out at me is John Authors in his Bloomberg column.
Okay.
He makes this really interesting comparison between what's happening in the market now and what happened after the 1928 election.
Oh, wow.
When Herbert Hoover won. And he points out how, like, the Dow Industrials followed a very similar trajectory after both elections.
So basically what he's saying is, like, are we going to see another, you know...
Another kind of boom and bust cycle like we saw back then.
Another 1929 kind of situation.
All right, exactly. And I think that's why it's so important to look at these historical parallels because, you know, markets do rhyme. They don't repeat.
Right.
But there are definitely patterns that you can see over time.
Yeah. And when you combine that historical comparison with something like Figure 8, which shows that not only is the price to sales ratio really high right now, but the price to book ratio is at a record high.
Wow.
It's like we're in this totally uncharted territory when it comes to how expensive stocks are compared to like the actual underlying businesses.
Right. It's like, what are they actually worth? Right.
Yeah.
Like at some point, there has to be some connection to reality, to the actual
fundamentals.
Yeah. The earnings, the assets, like all that stuff.
Yeah. And then on top of all of this, we've got the Buffett indicator.
Right. The famous one.
Yeah. The one that Warren Buffett uses to kind of gauge if the market is overvalued.
Right. And that's basically just looking at the total value of the stock market compared to the size of the economy.
Yeah.
And I guess that's at a pretty...
It's at an all-time high of 202%.
Wow.
So the total value of the stock market is more than double the size of the entire U.S. economy. I mean, that's
pretty hard to wrap your head around.
It is.
You know, it's like, it's one thing to say that a stock is expensive, but it's another thing to say that the entire market
is out of whack.
Yeah, it's just totally out of whack.
Yes. So the question becomes, if it's not strong economic fundamentals that are driving this rally, what is it?
Right.
And one of the ideas that the sources put forward is that there's just a ton of extra money floating around globally.
Okay.
And some of that is finding its way into U.S. stocks.
Okay.
Coming from places like cryptocurrencies, gold, even shares of companies like Tesla.
Oh, interesting.
Yeah, and Figure 10 actually shows this trend of monetary easing.
So that's basically central banks making it easier to borrow money.
Exactly.
Yeah.
And so that kind of lends some support to this idea that it's not really about the fundamentals. It's just that there's so much money out there.
And it's got to go somewhere.
And it's looking for a place to go.
Yeah. And so The U.S. stock market, I guess, is seen as kind of a safe haven in a world where there's a lot of uncertainty.
Yeah, maybe that's part of it. And then, speaking of uncertainty, we've got this new administration in the U.S.
Right.
And, I mean, Bill Bonner, he doesn't mince words. He calls their policy proposals an incoherent jumble.
Oh, wow. Okay.
Yeah.
Yeah.
And, I mean, he does say that they might be seen as more business-friendly than the previous administration. But overall, it's not exactly a picture of, like, clear economic leadership.
Right.
Yeah. So that adds another layer of, like, okay.
Uncertainty,
yeah. Like, even though the market seems to be really optimistic about this new administration.
Right.
Maybe that optimism's a little bit premature.
Yeah, it's like, are they going to actually be able to deliver on what they're promising?
Right.
And will that actually translate into economic growth?
Yeah. And then, to complicate things even further, we've got what's going on in the bond market. So John Authors points out that with the yield on the 10-year Treasury bond being around 4.3%, it's kind of hard to justify the current high valuations we're seeing in the stock market.
Right.
You
can get a pretty decent return just by holding those bonds.
Right. And they're considered safer, than stocks.
Right.
And then when you look at the dividend yield on the S&P 500, Figure 11 shows it's near a record low.
Wow.
So you're not getting a lot of income from those stocks.
Right.
And then because bond yields have gone up, this thing called the S&P 500 excess CAPE yield is super low.
Okay.
And you can see that in Figure 12. So basically, all of that means that stocks are looking less attractive compared to bonds.
Right, because you're not really getting compensated for the extra risk you're taking.
Exactly.
Yeah.
So that's another thing that's kind of like,
yeah.
Interesting. Yeah. And it's not just about the overall market either. Yeah. John Hussman, he brings up this really interesting point about what usually happens to those big companies. The ones that dominate the market.
Okay, yeah.
After periods where they get, like, super big, like how the Magnificent Seven are now. And Figure 13 shows that after, like, those previous market peaks. In 1929, 1973, 2000, those leading stocks, they actually ended up doing worse than the average stock in the years that followed.
Oh, interesting. So, like, what goes up must come down kind of thing.
Yeah, kind of. And so it's like, maybe that's something we should be thinking about now, too, with these Magnificent Seven.
Yeah, I mean, they've had an incredible run.
Yeah.
But can they keep it up forever?
Right.
That's the question.
And then you've got this other weird disconnect.
Okay.
Where you've got individual investors seemingly increasing their bets on stocks.
Okay.
You can see that in Figure 15. It tracks small speculators' net positions in futures.
Okay.
But at the same time, the insiders, so the people who actually work at these companies.
The executives.
Yeah. They're selling their own stock at a record pace.
Oh, wow.
Yeah, that's according to Figure 16. And there's also a report in the Financial Times about this. It's like they know something that the rest of us don't.
Yeah, I mean, it's always a bit of a red flag when you see that kind of divergence.
Right.
Where the public is piling in and the insiders are cashing out.
Yeah.
Yeah.
And just to add another layer to that, insider selling was also really high after the first Trump election back in November 2016.
Oh, interesting.
So it's like maybe there's a pattern here.
Yeah, maybe.
Yeah. So, I mean, to sum it all up, the picture for U.S. equities is a little bit mixed. On the one hand, prices are high.
Yeah.
Investors are super enthusiastic.
Right.
But we've got these warnings coming from historical comparisons, valuation metrics,
right,
and even the behavior of those company insiders.
Yeah.
Now, the report does say that, the rally could keep going.
Okay.
Like how the Hoover rally did back in 1929. Figure 17 actually shows that.
Okay.
But I think we all know how that one ended up.
Yeah.
Not so good.
Not so good.
So
a little bit of a cautionary tale there.
Yeah, for sure. So with all of that in mind, the report suggests that maybe we're at like this major turning point in financial markets.
Okay.
And they recommend thinking about reducing your exposure to the Magnificent Seven stocks. The related tech companies,
right,
semiconductor manufacturers.
Yep.
And they say, be careful about chasing like those really high momentum assets.
Like Bitcoin and stuff like that.
Yeah, exactly.
Yeah.
Okay, so now we're going to switch gears completely.
Okay.
Talk about a totally different part of the world.
All right.
China.
Interesting. Yeah.
Yeah. So we've got Kevin Duffy here.
Okay.
And he's making this bull in the China shop argument.
Oh, interesting. Okay.
Which is like the total opposite of what you usually hear about Chinese stocks.
Right, because usually it's all doom and gloom.
Yeah, especially in the Western media.
Uh-huh.
Yeah. So he's saying that these stocks are actually undervalued right now.
Okay.
And that everybody in the West pretty much hates them.
Uh-huh.
But guess what? China is still on track to become like the biggest economy in the world.
Yeah, I mean, that's hard to argue with.
Right.
They've been growing at an incredible pace for decades.
Yeah.
And there's no sign of that really slowing down.
Right. And he does acknowledge that, the property bubble in China is unwinding.
Uh-huh.
And that's definitely like a big factor in why those valuations are so low right now.
Right, because that's created a lot of uncertainty.
Yeah. It's causing like a classic balance sheet recession over there.
Yeah.
But his point is that even with all of that going on, there's still a huge opportunity.
Okay.
Especially for people who are willing to think long term.
Right, because the story of China's rise is not over.
Yeah. Exactly.
It's just kind of entering a new chapter.
And it's really interesting how he talks about all the negativity coming from the U.S. towards China.
Uh-huh.
Because he's like, maybe it's not all deserved.
Oh, okay.
Yeah, like he suggests that it could be tied to the U.S. government's own agenda.
Okay.
Using China as like an economic scapegoat.
Mm-hmm.
And then also just the influence of like all the media narratives.
Right.
Yeah,
because the media loves a good story. Right.
Right.
And a conflict between the U.S. and China is a great story.
Yeah. And then he makes this other really thought-provoking point.
Okay.
He's like, you realize the U.S. actually imports deflation from China.
Oh, interesting.
Right, because all those cheap goods that we buy,
Uh-huh.
it helps to offset the effects of all the money printing that's going on here.
Oh, I see. So it's like we're kind of benefiting from this trade relationship, even though we don't always acknowledge it.
Right, exactly. And so his argument is that if we try to decouple from China, or if we slap a bunch of tariffs on their goods, it could actually make inflation here even worse.
Oh, wow.
So that's something to think about.
Yeah, it's like we're kind of shooting ourselves in the foot.
Right. And it really highlights how interconnected these two economies are.
Yeah, absolutely.
And, Duffy points out that a lot of big U.S. companies, like Tesla, Apple, ExxonMobil, Qualcomm, all these guys, they make a ton of money from China.
Right.
And they rely on those lower-cost Chinese imports for their supply chains.
Yeah.
So it's not just like a one-way street anymore.
Right. That's like we need each other.
Yeah. And China's actually doing a lot to reduce its reliance on the U.S.
Okay.
They're trading more with emerging markets. They're even buying fewer soybeans from us.
Oh, wow.
Yeah. And then you've got this whole thing with the renminbi.
So that's China's currency, right?
Yeah.
Yeah.
And it's being used more and more in international trade.
Oh, interesting. So like a challenge to the dollar's dominance.
Yeah, potentially.
Yeah.
So it's like things are shifting.
Yeah, definitely.
Yeah. And then we've got Louis Vincent Gave, who offers this really interesting take on what's happening in China.
Okay.
He's like, all these bankruptcies that are starting to pop up, maybe that's actually a good thing.
Oh, okay.
Yeah, because it shows that China is actually becoming more capitalist.
So like a more dynamic system where companies are allowed to fail.
Exactly. He's saying it's more healthy than what we're seeing in the West.
Oh, interesting.
Where it seems like the big companies can never fail.
Right, because they always get bailed out.
Exactly.
Interesting.
Yeah. So it's a totally different way of looking at things.
Yeah, for sure.
And then when you look at China's global competitiveness, it's definitely on the rise.
Yeah.
I mean, Marc Faber, way back in 2002, he predicted that China would become like the workshop of the world. And Louis Gave, he points out that China is actually moving up the value chain when it comes to exports.
Okay.
So they're not just making cheap stuff anymore.
No.
They're becoming major players in things like cars, power plants, telecom equipment.
Wow.
And they're seeing these huge productivity gains.
Oh, really?
Yeah. I mean, he even uses the term mind-blowing.
That's incredible.
Yeah. And even in the tech sector, they're facing sanctions from the U.S.
Right.
But they're still making progress in chip manufacturing.
Oh, wow. So they're not letting that stop them.
No. They're finding ways to work around it.
Yeah.
So it's like they're determined to become a leader in all these areas. Yeah. And there's also this interesting point about how the Chinese tech giants that are traded in Hong Kong as ADRs.
Okay.
So those are the ones that are kind of more aligned with Western standards.
Got it.
They actually have these really strong share buyback policies.
Oh, really?
Yeah. Even more so than some of the big U.S. tech companies.
Interesting.
Yeah, and you can see that in figure 3 of our sources.
Okay.
So it's like they're becoming more shareholder friendly.
Yeah, maybe they're trying to attract more Western investors.
Right. Yeah. And I think one of the big takeaways from all of this is that this whole capitalist America versus communist China narrative, it's way too simplistic.
Yeah, I think that's a good point.
Yeah. Because when you look at things like economic stimulus, China actually took a more hands-off approach to its property bubble at first, compared to how addicted the West is to stimulus. And you can see some of those examples in Table 1. And then with trade, I mean, it was the U.S. that started the trade war.
Right.
And, the trade deficit is actually a lot more complicated than people think. And in the end, both sides usually end up losing in a trade war.
Yeah, that makes sense.
Yeah. And even with bankruptcy, it seems like China might actually be more willing to let the market forces play out.
Interesting.
Yeah, so it's not as black and white as people make it seem.
No, definitely not.
Yeah. And then there's some other interesting observations in the sources.
Okay.
Like Joseph Solis-Mullen, he thinks that whole China spy balloon thing was totally blown out of proportion by the media.
Oh, wow.
Yeah. And then you got Charlie Munger. He's actually pretty optimistic about the leader of the Chinese Communist Party.
Oh, really?
Yeah, which is kind of surprising.
Yeah, for sure.
And then Alana Mercer, she makes this cultural observation.
Okay.
She's like, China is looking to Confucianism for spiritual guidance, while the U.S. is kind of crumbling into wokeness.
Okay.
That's her view.
Yeah.
And apparently they're even putting more emphasis on classical texts in Chinese schools now.
Oh, interesting.
Yeah. So like they're going back to their roots.
Yeah, maybe they're trying to find some stability in a world that feels very chaotic.
Right.
Yeah.
And then Alzir McLeod, he points out that China's super high savings rate.
Oh, okay.
And 45% of their income.
Wow.
That's a big source of their economic power.
Right.
Whereas in the West, our savings rate is much lower. And he sees that as like a potential weakness for us.
Right, because it means we're more vulnerable to economic shocks.
Exactly. So it's like we're living beyond our means.
Yeah, maybe.
Yeah.
Yeah.
And, it's hard not to see the parallels between what's happening with the U.S. and China now and what was going on with the U.S. and Japan back in the late 1980s.